This conference will now be recorded.
All right, guys, so welcome to this edition of Traders Exchange. As always, everything that we're going to be talking about today is for educational purposes only, and nothing is intended as any type of investment advice. All right, so we got some really good questions today, and two of them kind of mix. And I'm going to read them both kind of together because I'm going to answer them both in the same way, and they both, kind of fit together with themselves. So the first question is, when we went over in class about variables yesterday, better to label percents this is not. Okay, so how to label variables and put percents to them so we know the exact percentage of what our trade is going to be. So how much percent can we label money flow? Seems to be a huge variable. All right. Now, the next question that's going to add into this is from that one that Tracy had before. And says, hi, Rich, you said some really great long trades have money flow of 90% sell. And I noticed that in APA. Why is that? So these both kind of have something to do with each other. All right, guys, I want you to understand something. And I know the market is based off supply and demand, but just because a stock has 90% buying, okay, and 10% selling, does that mean the stock will go up? So it actually posted something in a book. I forget which book it was, and I don't at all remember when the post was. But what actually determines what the price of a stock is going to do at that moment? Is it really determined based off 90% buy and 10% sell, the stock will go up? Think about it. No, it's not. Because at the end of the day, you got to think about it. The market moves based off of market makers allowing it to move. So if a market maker, they could be 90% buying going into a stock, but we could see the stock going down. Now, that doesn't mean that the stock's not eventually going to come back up, because overall, guys, the stock market really is supply and demand. But in the shorter time periods that we see things going on, that doesn't mean just because the money flow is going in is acquiring. Okay, remember, there's two different phases. There's acquisition and there's distribution. Okay, so you're either acquiring shares or you're selling shares or distributing them. But obviously with short going to be the opposite. So I want you to understand that a trade itself, can we use money flow as any percentage? Well, that's exactly it. What matters is the supply and demand right now. It really has the will of a market. Someone might want the stock up right this second. The money flow could be all sell, but the stock's going to go up right this second. Can we actually use money flow as a way to determine what percent a trade is going to be? You know what? I probably couldn't even give it 5%. Now, obviously, okay, I think the confusion is we look at money flow in the whole stock when we are looking at the way that smart money is going in and out of their position. It simply helps us to just adjust our own position. And that's really what it comes down to. Because one thing that you would use within money flow, and though he kind of put it perfectly, is that if we're in a stock, all right, and the stock has great buying, and it tells us that let's just say it's a $10 stock, okay, and the money flow going into it shows us that the stock can go to 11. But at 10:30 or 10:40, we start seeing a huge amount of selling coming out of the stock. What's going to happen? Are we going to get to that 11 right now? So it's a lot more to manage on what eventually needs to happen, or what's, depending on shorter term versus longer term. Remember, if money flow is setting up all day long with buying, is that short term or long term? It almost works exactly the same way that Prince works. Okay, if you have a huge amount of prints, it's going to be longer term. Why is a huge amount of prints longer term, guys? Let's get back to the basics. Why is a huge amount of prints going to be longer term? Because they're risking more and it takes them longer to get out. Yeah, that's not wrong, but that's not really why. It's because bigger position. Remember, when we see something go out there, that's the tip of the iceberg, and that's the perfect way to put it, is there's so much more that's underlying within that position. So when they're showing us that big of that many prints, we know that it's going to be longer term, because if they're showing us that, think about how much they actually need to do and they actually need to build. So shorter term money flow Okay, when we see not as much, when we just see, like, for instance, best example is going to be LK, and I'm going to pull up LK right now just to show you exactly what, when we come back in. What is the money flow in LK? No question whatsoever. What is the money flow in LK? This is, I mean, we couldn't get a better example. Obviously, we were talking about this, so. Distribution, they are selling the shit out of this thing. Excuse my language, but that's what it is, okay? And to make my point, I need to use use that. They are literally destroying this. It is short all day long. But when a stock shows us selling constantly, what ends up happening? That's 100%. That was scientific language. Scientifically, they are selling the shit out of it. But what ends up happening? It's science, Davis. What ends up happening when a stock gets hit over and over and over and over again with selling? This shouldn't be a hard question, and I'm not going to answer it. It's going to pull up, and if it has selling like LK did, what does an LK pull-up typically look like? So if we hit a level 5 times and the selling is just showing us the money flow is distributing constantly over and over and over and over again, yeah, it's usually a very big pull-up. So what's the higher percent trade? A short or a trigger short or a trigger long in a case where there's all selling? And when I say all selling, I mean selling and controlling print levels. I don't mean off levels, because if it's just all selling off levels, a lot of the time you'll just see the stock completely go. So it technically at that moment is the higher percentage is not short, because there's a certain point where it gets too much. Remember, it's not a good thing unless a market maker already has their position built for a stock to run. Okay, when a stock is running, guys, what happens to the orders and what happens to the amount that you can actually acquire? And let's say in this case, obviously, they would be looking to acquire shorts, okay, short shares. Okay, but what actually happens? It's difficult to exactly. So if we see a stock that's just getting hammered and hammered and hammered and hammered and hammered, can we chase it? Should we chase it? Will we be consistent and a consistent profitable trader if we do that? No, right? So we can't really even do anything with it. So in a case where a stock is overextended from selling, technically, what is the higher percentage trade for us to actually be able to take without chasing? Okay, remember, the further a stock gets away from where it needs to be, the higher the percentage of trade goes. So if we know that this stock needs to go, from 34 and we just keep selling and selling, and the stock needs to go up and still satisfy 36 prints, technically the trigger up in the shorter term will be a higher percentage trade at that moment. Now, the total trade is always good. The higher percentage trade is always going to be towards the print. But at that moment, if you're to take a short when something's overextended and needs to pull up, is that short a high percentage trade? Think about that. Is it a high percentage trade to take a short when there's all selling? No, it's not, right? So really the higher percentage is going to be the long trade. So technically, you can't really use that money flow. Each stock is going to be different, obviously, just like anything else. Each case scenario is going to be a little bit different. But really what I'm trying to show is that, like you said, could you, if you added 5% to your trade, okay, because you were using money flow, let's say it's, distribution like an LK, and you added 5% to your trade, it's not going to make that big of a deal. But at the same time, it's really not, it's not going to make a big deal either way. The trade needs to have its percentage without that in it. The prints are what's going to determine that. The variables coming into it. Money flow technically can't really add a percentage, because a lot of the times the heavy money flow ends up trading the opposite way first. It's chasing one-on-one. I've done it, and believe it, every single one of us has been there before. Every single one. But do you guys understand what I mean? So the money flow might be the complete opposite, like right now in LK. Hey, LK was a beautiful law. You can see that trigger that comes right up, and then the stock, so it starts pulling back above where it needs to go from its selling. On top of it having those ask riders there. But if we added money flow, that would take away from the actual trade of where the stock has to go first. They have to make their money, and a large position won't be satisfied by a small move, of course. It's easy to chase, harder to wait for a better move. Well, that's of course it is, because guess what? The market makers know that. That's how the human brain is programmed, and that's why they hammer stocks after people get in and start chasing. That's why we get those such big bars that come back down. But does everyone understand what I mean between the difference between money flow and the actual trade at that moment? They're two technically different things. Now, that does not mean that in no way does that mean that a trade with money flow is a bad trade. That's not what I'm saying whatsoever. But technically, can money flow give us direction? Technically, better way of putting it, should money flow be the reason we're going towards a direction? What tells us direction, guys? What tells us direction? Show of hand, controlling prints, right? It's not the money flow itself, because remember, it could be all selling and then we could get a great long trade that comes into it. So there's a difference between prints and money flow. I know that sounds crazy because technically prints create money flow, but there's a big difference between them for actually trading. Okay, just because the money flow is leaned one way, a huge way, one way, does not mean that's the direction that the trade's going to be at that moment. Because one thing that we all know, when we see just way too much selling, guys, what does everyone here look for and wait for? Even if I'm in a trade and it's just selling and parabolic and moving and moving and moving and moving, guess what? That's a lot of times you know that they're gonna try to hammer down on somebody. So you have to be looking for that. Money flow don't give you an added variable to an entry, but simply helps you once you're in to justify holding at certain points. Perfect, absolutely perfect. Any questions? Chasing money flow is when you see all selling and you try to trade everything as if it's a gift. So money flow is not the show of hand. Money flow is the overall buying and selling that's going into a stock. Okay, so think of a spectrum. Does everyone know? And everyone here has taken a science class before. Okay, does everyone know the difference between a base and an acid? The scale? I think it's 1 to 7. I don't remember. I was terrible with science. I was never interested in it. But does everyone know? So there's a spectrum. So think of the spectrum of money flow as buying and selling. So there's a needle that goes back and forth. So if let's just say the stock opens, there's 10 buy prints and 10 sell prints, all of equal value. Where does the ticker go on the money flow spectrum? Yeah, right in the middle. Now, if we have 5 buys and 15 sells, guess what happens? The money flow indicator now goes where? Starts going towards the sell side. If we have 15 buys and 5 sells, the ticker will go towards the other side. That's what money flow is. It's just the buying and selling that's coming in and out of a stock. But that doesn't mean that the stock is going to move in money flow's direction. Because the money flow itself is not what controls where the stock moves. You also got to think of something too, guys. Okay, do we know what positions in inventory market makers hold? We can get a little bit of an idea by, like when you really start to see this, you can get an idea of probably what they're having by what they're showing you on the tip of the iceberg. But no, absolutely not. So guys, if someone was building a long position, let's say for a year, let's just make something crazy up just so you can get the mental vision, was building up a long position for a year straight, millions and millions of shares. Guys, when they're looking to get out, okay, let's say they get out, I know, the whole day looks like it's selling. Okay, what does the money flow technically look like to you? That day, what would the money flow technically look like? Oh, it'd be all selling, right? So we would think their distribution phase rather than the acquisition phase. But if they were building a position for a year and that day they got out 2 million shares, but they really have 100 million still in play, technically, is the overall money flow actually selling? Or is it actually buying? Which one would it be? So these are things that you have to think of. So it's almost impossible to a certain extent. Don't get me wrong. If there's like a year-long consolidation and then the stock jumps up $20, then guess what? We know the money flows long. Okay, it's very simple to understand. But we really don't know as an overall thing unless we see it happening for days and days and days and days. But one thing we do know is once we're in a stock, can we determine how much is going in from the point of entry to how much is going out? Can we figure out what the money flow is at that point? Sure can. And there goes to Doug's point. We use it as an indication of what they're showing us when we're managing something. Because at the end of the day, anyone, you could tell me right now that the money flow in LK is short. It really technically could not be. Now, do I think it is? I sure as hell do. But technically, it might not be, because guess what? If we look at the actual daily on LK, maybe they were building a position since it's been open. So all this selling coming in is just someone locking in a ton of profit. That's a very strong possibility, isn't it? If we look, this is a long consolidation. You're talking about all the way back here from May, okay, up until November. So technically, when we think about it, guys, could the money flow actually still be on the acquisition side of things? It technically could. You see what I'm saying? So if you go by money flow, technically we can only know the money flow for when we're literally sitting there watching a stock. And obviously we can make assumptions. And when I say assumptions, I mean high percentage assumptions. Like we know that after the stock kind of broke out like that, then almost guaranteed that at some point that somebody was building a long position during that consolidation phase because it went up. We can assume that the money flow in that consolidation was acquisition. Otherwise, it wouldn't really make much sense to jump it up that high from here to then bring it down. I mean, don't get me wrong. I mean, $18 jump up is a little bit exaggerated, because if they're going to jump it up $18, they might as well just buy, and there would be so many more people that were buying, and we'd still be able to actually see that. Okay, but we got to think logically. Okay, understanding how the market actually works, understands how to interpret things. I told you guys this morning, that's what our next class is going to be about, is how to interpret prints based off of the puzzle that's there right this second. Because anyone here remember what LK did in May? May of 2019. Anyone here remember? Was anyone watching it all day long? No. You know what I'm saying? Does this make sense to everybody? Everyone understand where my point is? So that's why there's a big difference between money flow and prints. Money flow is not giving you the trade. It's helping you manage something and understand what's going on. It's also understanding the money flow, guys. Is that also going to help you interpret prints as well, though? Is understanding what the money flow in a stock is also going to help you interpret what the prints show? Of course, absolutely. So understanding the money flow is making you a better print reader at the same time. It's just not going to be the deciding factor behind any type of actual trades. Especially in cheaper stocks. Oh, Derek, you hit the nail on the head right there. The cheaper stocks money flow is so much more important. But the reason that money flow is so much more important in cheaper stocks, guys, is because when did the story start? When we first see it, that means when did the story start? Or the story that we can actually see, yeah, it just started. That's why the money flow is so important in cheaper stocks, because we can actually use it for something. The money flow is happening as we're actually looking at it. I don't know what the hell happened when LK was in this consolidation, but if we go to a cheaper stock, let's just use SDDC for a second. We go to a cheaper stock, I know exactly when this one started. It was like 3 days ago. You see what I'm saying? So that's it. Literally just fits into that exact puzzle of what actual money flow is because when its story just starts. Remember, we have our textbooks that our Apples and our Babas and our Facebooks and stuff like that, and then we have our Cliff Notes, which is our cheaper stocks, our stocks that literally have usually 15 minutes of fame, and they started happening that day. Now, don't get me wrong, the building of a position didn't happen that day, but once it pops, we know that it was acquisition, it was buying. It had to be heavy buying money flow because they knew that the stock was going to pop. Our assumption, we know that every market maker knows exactly what's going to happen. So we can actually watch it from that moment on, from that day on, and know exactly what's going on. Okay, on a stock like Apple, anyone know what, well, I mean, I kind of have an idea, but anyone know what the money flow in Apple is today? And remember, direction's not going to tell us. Anyone know what the money flow in Apple is today? Remember what we just talked about. Yes. But no, of course you don't, because you have no idea what happened. I mean, don't get me wrong. I'm going to have to say they've been acquiring because it's at 300 and 300 has hit a billion times. But you guys understand what I mean. No one knows what the hell was being built for 3 months previously and what was coming up. Are they set? You know what? You understand? But the prince will tell us. So this one, we can almost assume the money flow is buying because we know they're building a position at 300. They keep hitting it and buying and buying and buying and buying. So we kind of, this is, like I said, this is an easy one. If we go to a stock like, most of them are going to be up in these uptrends. I don't remember a daily that, or like for instance, right here, okay, in a stock like Facebook during this time period, no one's going to be able to tell what the money flow in this was because coming back, it's not going to work because you don't know what happened 2 months ago. You don't know who's been building for 2 years, investing, and blah 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 blah. But when it's a cheap stock, we know exactly what it is. Make sense? Good to go. Oh man, it's funny because Doug used the word money flow. I think it was like when we were doing our last classes, and ever since then, it's been like, it's a huge topic. That's all it is in a nutshell.